Good day and welcome to our 2023 First Half Fund Update Series brought to you by Sanlam Investments. I'm Gilly de Swart and I head up the retail distribution function at the business, and I am your host for these sessions. Today, I'm delighted to share some exciting updates that will enhance your webinar experience. To begin with, we've recently migrated to a new platform provider, On24, ensuring a smoother and more reliable experience for all attendees. With this transition, you've probably already seen that we've also made improvements to the registration process, enabling you to register once and select the webinar presentations that you would like to attend. Although we now offer one session per fund feedback, you are still able to access the recorded sessions at your convenience and still earn your CPD accreditation. Don't be afraid to experiment with the dashboard on your side, as the platform does provide customizable features, allowing you to tailor the webinar experience to your preferences. Lastly, the platform does have an invite function that allows you to easily invite colleagues or clients to join these engaging sessions. Today, when we look back at the first half of 2023, we have seen central banks continue their relentless fight against inflation by increasing interest rates at an extraordinary rate. While we may have seen the peak of inflation, it has remained stubbornly high. These rising interest rates have increased borrowing costs for individuals and placed consumers under immense strain. We have been receiving warnings from economists that we could be facing recessions across multiple geographies. Against this backdrop, equity markets have surprised us with remarkable strong performance since the start of the year, not only in the US, but also here at home. While the high interest rate environment has placed strain on consumers, investors are being offered very attractive yields on South African bonds. As with all asset classes, it comes with its own set of risks that needs to be carefully considered and managed. Now I'm going to hand you over to Ruan and Nico Katzke, who will discuss the first half of 2023 from an indexation point of view. They will discuss what has been driving markets locally as well as globally, and also delve deeper into our local indices. We've reached out to the JSE for their perspective on some significant changes coming in the next couple of months and how Satrix see this impacting investment portfolios. Finally, they will also consider equity allocations and the importance of spending time in the market and share an interesting case study with regards to investor behavior. Please utilize the Q&A functionality to ask Nico any questions you may have. I will cover as many of your questions during our live Q&A section at the end of the session. Gentlemen, welcome, and I'm handing over to you, Ruan.
Thank you, Gilly. As mentioned, my name is Ruan, and I'm an account manager with the retail distribution team. Joining me today is Nico Katzke, who's the head of portfolio solutions at Satrix. Welcome, Nico.
Thank you, Ruan.
Awesome. Nico, I'm going to jump straight in. Last year, markets were mostly in the deep red territory, with broad market indices suffering significant losses. Things have turned around quite a bit this year. Can you give us some deeper insights into what has happened?
Ruan, you are right. Last year was a very difficult year for most asset classes. You know, the S&P 500 was down more than 18%, the MSCI ACWI down 18%, NASDAQ down 33%, and even the global aggregate bond index was down 16%. So clearly there was nowhere to hide. This year we've seen markets strongly rebound. You know, the S&P being up close to 17% by the end of July, and the NASDAQ being up nearly 40%. Now, while these numbers sound phenomenal, many analysts have actually pointed to how concentrated these returns actually are. So the slide that I'm showing you now from Bloomberg shows that the majority of the S&P 500 recovery this year to the end of May has actually been from a handful of growth stocks that you see there on the left, and that the S&P this year was actually mostly down. So it's only really that you're seeing this growth recovery coming through. Now, locally, we've also seen a positive start to the year, albeit nowhere near as dramatic as what we've seen in other indices. What is notable from this slide, though, is that the Aussie is up nearly 20% over the past 12 months. All this while the Swix is up only 13%. Now, this immediately begs the question why these benchmark returns actually differ so much. Now, the next two slides provide us with some context for the differences in the index returns that we've seen. In fact, it breaks down the returns of the Aussie into its top contributors on the right and also its top detractors on the left. Now, what we see from this is the local index returns were also quite concentrated to a few growth counters, as we've seen in the S&P 500, namely your Richmond, Naspers, and Prosus. In fact, Richmond alone contributed almost 9% of the Aussie's 19% of the last year, so that's quite phenomenal. Now, if we look next at the capped SWIX, we see that it lagged the Aussie by almost 7%. But, if you look closely at these two slides, this difference is almost entirely due to its underweight in Richmond, having an average weight of 3% in the capped SWIX compared to the Aussie's average of 15% weight over this period. So clearly, if clients query the big difference in benchmark returns, the simple explanation for last year was just its underweight in Richmond.
Okay, Nico, so you've mentioned the fact that we've got two broadly accepted definitions in our equity markets. We've got the Aussie and we've got the SWIX methodologies. So depending on clients' conviction, they can invest in either. Does it really matter, and does that decision make a difference over the long term?
Yeah, Ruan, so somewhat confusingly, the SWIX and Aussie indices offer two alternative definitions of our local equity market, with the SWIX being the more broadly preferred benchmark for local asset managers. The Aussie uses the full global float for some companies that had their initial listings in South Africa, but which subsequently moved their listings offshore. Now, these are actually called grandfathered stocks. And although many of these, notably Billiton, Richmond, and a few others, have actually in recent quarters had corporate actions that have made their floats the same between the SWIX and the Aussie. So the SWIX, in contrast, only uses the available float on the local straight register. And so it is actually a better reflection of what is held by investors locally. Now, to see the performance differences, as you ask, over time, we plot here the rolling 3-year returns relative to the Aussie. Now, the Aussie there is the light blue line on the zero axis. Now, from this graph, it is clear that the Aussie has led the way since 2018, very clearly, having mostly actually lagged the SWIX from 2010 to 2018. So we a sort of change in fortunes, if you like. Now, I've also plotted the median active manager performance in the gray line that you see there. And from it, you can see how closely it tracks the SWIX returns over the last few years too, albeit consistently below all of these indices that I'm showing you. So active managers have really struggled relative to these indices. Now, if we add the mid and the small cap indices as well, you can see these being the kingmakers, if you like, when it comes to comparing the capped alternatives through time. So, and this is due to capped alternatives by definition having more weight to the smaller companies. So very clearly over time, tracking the right benchmark really makes a massive difference and has an enormous impact on your investment performance. As you can see there at the end, with small caps and the mid caps doing so well, you see the capped Aussie and the capped SWIX outperforming their parent indices.
So, Nico, apart from the weights of a few shares that you mentioned differing between the Aussie and the SWIX, it does seem like their performances deviate quite a bit. Are there any other perspectives that you can share with us that actually shed some light on why they would differentiate themselves so much?
Yeah, absolutely. One key reason for the big differences in Aussie versus SWIX returns the past few years have actually been due to differing rand sensitivity. So on the next slide that I'll show you, we calculated the average rand sensitivity to the pound, euro, and dollar of every company in the all-share index. And we use it to create a weighted sensitivity score for each index over the past 12 months. Now then we compared the sensitivity of each of these indices relative to the Aussie, so the zero line that you see there to the left, with positive values being indicative of a rand play and lower or negative values indicative of a rand hedge. Now, it very clearly shows you on the right that the SWIX methodologies offer more of a rand play compared to the Aussie methodologies, which resemble more of a rand hedge. Now, why is this important, you might ask? Well, consider the fact that the top 25 rand hedge stocks over the past 3 years, so if we look at compile the top rand hedge stocks, we see that on the left box plot there, the green box plot, those stocks had an average return of 22% over the past 12 months. And that the top 25 rand play stocks actually had an average return of minus 7%. So it's then no surprise that an index like the Aussie that had more rand exposure or more exposure to rand hedge stocks would have likely performed significantly better over the past year, just considering that. Now, looking ahead, investors might well conclude that, the Aussie would be a superior methodology as it derives more of its earnings from offshore and offers a stronger rand hedge. But to this, we'd simply say it is seldom just as simple as that, as you can imagine, and that less risk concentration is really what clients should be looking for. And our estimates certainly suggest that the capped SWIX is a better diversified index. And also, of course, many believe the rand to be oversold at its current levels. So in this case, it might very well be that the past is not our best indicator for which is the best benchmark to consider.
All right, so Nico, I think we can discuss the past differences between the Aussie and the SWIX at length. But it's important for us to show our investors what's happening in the future. And you recently spoke to Mark Randall, director at the JSE, about their communication regarding index harmonization. So we have a short video clip where you ask him a few questions related to the difference in methodology and how the JSE will align these indices to make it simpler and more unified. So let's watch the clip.
Thank you, Mark. Mark Randall from the JSE for your time today, just to give us some more insight into index harmonization, how the indices have changed in recent months and how they've actually aligned. Mark, the first question I want to pose to you is, what is the index harmonization project that the JSE has announced all about?
Yeah, thanks, Nico. And this is something that we really have been working on for a couple of years now, certainly the last 3 or 4 years. So I'm glad to announce we're close to the end of this project. But if you think about it today, we've got two broad market benchmarks. We've got the FTSE JSE All Share Index and the FTSE JSE SWIX All Share Index. Both of these have been designed as broad market performance indicators to help measure market performance. And what we've seen is that these two indices have got exactly the same constituents in them, but they've got different weighting methodologies. Now, in 2004, when the indices started, the difference in weightings was quite significant. But over time, we've seen that weighting converge. And we speak about the so-called London 5, companies like Old Mutual, SAB Miller, BHP Billiton, and so on, and some other more recent ones like Richemont. And these are really the companies that have driven the difference between the All Share and the SWIX All Share. But what's been so interesting is over the past 5 or 6 years, due to a number of corporate actions, most of this differential treatment has actually fallen away. And we're now in the position where only Anglo-American is the company that's got sort of a significantly different treatment between the two indices. So the index harmonization is all about getting rid of the difference between harmonizing the methodology between the All Share and the SWIX. And we want to intend to remove the last difference between these two indices from March 2024, from which point we'll only have one broad market benchmark methodology.
So, Mark, maybe for those that are not privy to this information, why do we have two methodologies in the first place?
So I think like any index question, it's all around weightings and concentration and what is in your index and where the overweights are. And going back, sort of winding back the time clock to 2004, in fact, when we created SWIX as an alternative index, there was a major concern at the time that the weighting of these global companies were resulting in them having too large a weight in the All Share. So SWIX was really introduced to downweight foreign dual-listed companies relative to domestic companies, and to give index users an option in terms of what kind of benchmark they were trying to use.
So with the view on harmonizing these indices, why do you think it is important to have one methodology?
I think from the FTSE JSE perspective, we really believe it's critical for domestic equity markets to have a credible performance benchmark. These are things that are widely published, widely analyzed. People consider them all the time when they look at performance. What we've seen over time is the majority of domestic asset managers have settled on the SWIX All Share methodology as their de facto performance benchmark, many of them using a capped variant of that. And what we've seen is having these two indices that are increasingly convergent makes it really difficult to have a conversation with investors. You know, what is the difference? What is the purpose for each one? Why are we splitting liquidity across derivative products? Why do we have to have two stories all the time? And really, given the diminishing difference between the two indices, it's about simplifying it into one country benchmark, one story, one narrative. And we really think that's going to simplify things both for investors and those people that advise them.
So practically speaking, what does it mean for example, the top 40 index, which underpins the Satrix top 40 ETF and other indices like the CAPI? What does this practically mean?
Yep. So I think first and foremost, any index that has SWIX in its name today has got no change. So any of the SWIX 40 or SWIX All Shares or SWIX ratings remain completely unchanged. However, the top 40s may be a good example to speak about because it is so widely used. Effectively, what we're doing in the top 40 is we're going to change the weighting so it is identical to the SWIX 40. What that means, practically speaking, really is Anglo American, as I said, is the only sort of last bastion company, if you like, that has got a major differential treatment. Around about over 10% at the moment in the top 40 index and 3 or 4% in the SWIX 40 index. So we'll be looking to decrease the weight of Anglo American in the top 40. Obviously, that weight will then be redistributed across the basket, so we'll see an uptick in the rest of the stocks. But at the end of the day, we're going to see one major rebalance in March 2024, which will adjust the weights of the top 40 and indeed the cap top 40 to look like the SWIX 40 and the cap SWIX 40.
And so related to that question, what does this mean for index funds more broadly that track your indices?
So I think this is an important question, Nico. Thank you, because the point of our harmonization project was really around market benchmarks and how we impact the all share space and how people think about market performance. Certainly, the world of index funds is far broader than that. We don't expect all index funds to use the market benchmark as the underlying index. And certainly, as we look to create different variants, there is still room for that in the FTSE JSE index series. I'll give you an example. One index we're working on at the moment is a concept of upweighting all of our global companies to really take advantage of their enhanced liquidity, some of their database valuations and offshore activities. We're seeing some demand for that in the product space. But equally, whether that is a sort of a style base or a different weighting or a thematic index or a sector index, these are all things that lend themselves naturally to index funds. And certainly now that our harmonization is pretty much out of the way, we're going to be spending a lot of energy on making sure we're creating the right index for the right product.
So at the end of the day, you want one representative benchmark and then specialist indices that serve a different purpose for your clients.
Correct. And specialist indices largely, whether they're for derivative products or index funds, I think here it becomes a bit more nuanced. It's not a broad market need, but really an opportunity for us to work with our partners, such as Satrix, to deliver independent indices that really drive innovation that our investors are looking for.
Thank you. Thank you for your time, Mark. Thank you for your insights. We appreciate your time.
Thank you so much. Take care.
So, Nico, what stands out from your discussion with Mark is that the JSE believes that harmonizing these indices is an important step toward preserving the integrity of our representative local benchmarks. While discussions around harmonization started quite a number of years ago, why have they only started committing to the March deadline now?
So you are right in that harmonization talks were underway almost 5 years ago already. And during a time when this started, index concentration was a significant issue. If you recall, Naspers, Billiton, Richemont made up more than half of some uncapped indices, meaning benchmark indices became less relevant to managers looking to have a sensible performance hurdle to compare themselves to. Now, this led to some asset managers actually choosing to adopt industry median performance benchmarks. Now, this is, of course, not ideal as it leads to less transparency around performance counterfactuals, in other words, what investors might have earned, and as we've shown, is actually a lower hurdle to clear after costs. Now, the reason why the JSE has now finally confirmed index harmonization, as Mark referred to, which will happen in March, is because the indices have begun to align quite organically themselves. So on this slide, we show just a year ago, the big differences between the inward listed company floats considered in the weighting calculations of the SWIX as well as the ALSI. Now, Anglo's, Richemont, Goldfields, Investec and Mondi, as you can see from this slide, all had less than half of their float listed on the straight, and so were heavily downweighted in the SWIX methodology. Now, today, these differences have mostly disappeared, as you see from the shaded plot now, with only really Anglo-American, Investec, Mondi and Thungela having meaningfully higher floats in the ALSI. Now, from a holdings perspective, a year ago, Richemont made up around 12% of the ALSI, while only being 2% in the capped SWIX. Same for Anglos and to a lesser degree Mondi. The differences were quite stark back then. And this is even after, if you recall, Billiton was aligned as well. Now, forward the clock to today, and you can see that the only sizable difference remaining between the SWIX and the Aussie indices is actually Anglo's and Mondi. Now, you can now see why the JSE is using this opportunity to officially harmonize the benchmark indices to have just one local benchmark, as you know, it is hardly disruptive to do so anymore.
So the JSE indicated that from March next year, this alignment will happen. And at that point, the SWIX will drop away. We'll be left with the Aussie. And the Aussie at that point will then be calculated according to the current SWIX methodology.
Correct.
All right. So could you briefly conclude this discussion around the benchmarks and just give us an idea of from now until March next year, does it really matter which one you choose?
Yeah, it's a great question. I think the short answer is yes, but far less than even just a mere month ago, Ruan. Consider, for example, how active risk on this slide, or projected tracking error, if you like, between the two indices have plummeted to below 2% between the SWIX and the Aussie, down from around 6% just 2 years ago. So 2 years ago, the difference between the two were quite stark. Looking ahead now from March, we still favor the capped SWIX from now to then. Firstly, as the methodology will align, like you mentioned, to the SWIX currently in March anyway, so it might just be easier to align yourself to the SWIX already. And secondly, as it is less concentrated than the Aussie methodology. Let me just briefly show you. For example, this graph shows the contribution to overall risk, that's the blue line, as well as weight contribution of the top 5 stocks over time for the SWIX as well as the Aussie. Now, the blue line shows that currently still around 40% of the capped Aussie's contribution to total risk is due to the largest 5 stocks, which make up around 35% of the index weight. Now, for the capped SWIX, the contribution to risk number drops to about 30% and a weight concentration of around 27%. So, a bit more or a bit less concentrated, the capped SWIX currently. But these differences are minor compared to a few months ago. So you can definitely give your clients comfort that the large return differences that we saw between the SWIX and the Aussie the last year is hopefully largely behind us. And this will completely disappear from March onward.
So after the last 2 years, there's been a lot of noise and uncertainty. So we've had geopolitical tensions, there's been inflation, there's been issues with trade and energy. So investors will be forgiven for wanting to maybe invest in more cautious assets or even taking their money out of the market altogether. What is your message to these clients to stay in the market?
Look, there's definitely enormous uncertainty over what the next few quarters will hold. And investors may rightly ask whether taking risk with your hard-earned capital is a sensible thing to do now. But we've always maintained the view that timing your entry and exit points is not what matters for long-term wealth creation. What matters most is consistently building the most tax-efficient and cost-effective equity exposure through time, through the cycles with limited intervention. Now, to give you a sense of just how consistently equity exposure has offered you real returns above long-term inflation, we show what the probability of earning more than 6% annualized over the past 20 years has been when investing on any random given day in the all-share index for the different holding periods that I show here, like a week, a month, 12 months, etc. So even though times are currently uncertain, and we have an urge to believe, this time is going to be much different, it helps to get some longer-term perspective that even through the noise in the past, and there's certainly been a lot of noise in the past, and deeply uncertain periods. If you think a decade ago, we were in a global financial crisis. Even despite this, markets tend to remain resilient and find a way to adapt. And over the medium to long term offers a premium for those willing to bear some short-term risk. So putting R1 in the Aussie on any given day in the past had a less than 15% chance of earning less than 6% annualized over 5 years.
So, Nico, if we think about a different type of client, someone who saves every month diligently, and they're trying to harness this power of compounding, but they look at your graphs and they see that there is a possibility that over 5 years there's a 15% chance that they could hit a negative market or a negative return. What would your advice be to them?
That's such a great question. While we cannot predict the future, history actually teaches us that the greatest risk to your investment portfolio over the medium to long term is actually not taking any risk. The certainty of capital erosion through inaction is very clear. Now, the key here is to not confuse saving and investing. Saving means you are storing seeds safely for consuming it tomorrow. Investing means you sow those same seeds in order to reap a harvest in a few years. Now, sowing takes discipline and entails taking some risks, but the rewards can actually be quite great. Now, the reality is that clients often hear the term compound returns and that it's the eighth wonder of the world and all these wonderful things, but they fail to appreciate that not all compounding is equal and that the source of compounding actually matters so much. So we recently wrote an article where we showed just how important what you do with your savings is compared to how much you contribute to your savings pool. So the illustration is quite simple. Let's say you have two people, and let's call them saver and investor. So, really generic names. And they start off with the same salary of 10,000 Rand. Now, suppose that both set aside 10% of their salaries each month. So they don't consume everything they earn. They're quite diligent in doing so. Now, where they differ is that investor focuses much more on what he does with his savings pot, while saver focuses more on growing his savings contributions and cares less about being productive with it. In fact, you can think of saver as being risk averse, and so places his contributions in an interest-bearing account of 5% annualized. So those of you watching, advisors, for example, even casual savers, might relate to this. You don't want to lose money, so you put it somewhere safely. Now, saver is all work and no play, right? He is getting a CFA, MBA, PhD, and is trying to increase his salary by double long-term inflation on average each year. So phenomenal salary growth. Investor instead accepts some risk and puts his savings in, let's say, the Aussie Top 40 index. So to gain this equity exposure that I mentioned earlier. And he simply gets a pay rise in line with inflation. So not really even trying. In fact, he has aspirations of doing the Camino, going skiing, living his best life, not just working. Now, as you'd expect, savers' contributions over time will be significantly more than investors over this 20-year period. And even though both set aside 10% diligently, that's because saver focuses on growing income, whereas investor just focuses on what he does with his. So in fact, the difference is almost 3 times more contributions from saver due to this hard work and salary increasing efforts. But the next slide is the key one, Ruan, because this shows that investor, despite contributing less than half what saver did, was able to retire much more comfortably. Now, this is quite depressing, right? To see that despite working so much harder and earning so much higher income, saver actually retired with less than investor, who was simply willing to accept some risk in order to gain a higher return. Now, from this, the lesson is very simple. Growing wealth is not only about harnessing the power of compounding, because both actually did this. The source of compounding matters greatly. So you should ideally focus more on what you do with your income instead of just working hard to grow it. Unfortunately, we are as a society primed to be income maximizers, not wealth creators. And so this requires guidance from your side to your clients to understand this. Now, strikingly, this figure doesn't even include all the other tax benefits that advisors can add, but simply underscores the importance of taking some calculated and well-rewarded risk with your investments over time. And then, of course, it'll be remiss of me not to mention fees. And we must keep this in mind, that the power of compounded fees is just as powerful as compounded returns. So this slide shows you that even if you are taking well-rewarded equity risk, if you pay too much for it, you could actually end up hurting your prospects of growing your wealth. So here we show what you would have earned had you invested 1 million Rand in the Satrix Top 40 ETF in December 2000. Now, what you paid in additional fees through time would have mattered massively. In fact, an additional 3.5% annual fees over 20 years would have halved your returns. I mean, this is phenomenal. Now, of course, advisors should be rewarded and can justify their fees through good guidance and providing tax advice, absolutely. But clients should be made aware of high management fees and other inefficiencies that can serve to work against them over time.
Nico, you've shown us that for compounding to really work in your favor, you need to take some risk to get reward. And that being conscious of what you pay is also very important. So what is your view on the investment vehicle that you use to gain this equity exposure? Does that also matter, and why?
Yeah, so how you get equity risk exposure absolutely matters. So we've made the point in the past that it shouldn't be a discussion of a choice between active and passive, but it's rather a continuum between rules-based and actively designed strategies. And for most, the best solution is a combination of rules-based and active strategies. So we see first that vanilla indices, or as some like to call it, passive indices, this is a great way of aggregating the market's views and getting equity market exposure at the lowest possible cost point. Now, this can be viewed as your staple diet, right? Your rice and your noodles, as you see there in the top right. Now, non-vanilla systematic strategies, or, set of rules like factor funds, represent rules that are not designed purely only on the market's current views, but also adopt insights from the financial literature that shed some light on what type of companies outperform long term. Now, you can think of it as strategies that use a more refined set of rules, but which still provides clients with comfort that it is transparent, consistent, and of course, low cost. Now, lastly, investors in South Africa still predominantly make use of actively managed funds. Now, these offer the potential to outperform the market through conviction, research, and insight. And yes, while you do pay a higher fee, it is like ordering food from a restaurant, which you expect the meal to be of a sufficient quality that you can't make it at home, right? So I would argue that a blend of these strategies, so around this continuum, is the most sensible strategy. And that ensuring what you pay or the value that you get is what you're being paid for. So that would be the top priorities, just ensuring that you are well diversified across funds that are low cost, and transparent, and actively managed funds that add that value over time.
You mentioned vanilla, non-vanilla, and active management. So there are those that would argue that vanilla index investing is designed to underperform the market and so has limited value in a portfolio. Is indexation only a cost-saving exercise, or does it actually add performance benefits to your portfolio?
Yeah, so this is something we often hear, that with indexation you are simply saving costs and that it is a penny-wise, pound-foolish strategy. Now, to this I'd simply say, look, the numbers don't lie, and there is a clear performance benefit to be had as well. Now, if we look at the past performance compared to active peers of indexation strategies, then we see they've done remarkably well over time. And this is the case in South Africa as well as globally. So it's not like we are some outlier in this regard. Now, the figure that I show you now shows the distribution of 3-year monthly returns, with the zero line that you see there in the middle, the vertical line, being the capped Swix index after deducting 50 basis points. So we put it on a like-for-like after fees basis. Now, what this shows us is that 72% of the time, over the last 20 years, the capped Swix beat the median active manager over 3 years. Now, this is a phenomenal performance. The Cappy on the next slide, however, shows an even greater outperformance of 90%. So averaging the two, if you like, we see index alternatives beating the active manager roughly 80% of the time. And this is very much in line with global performance too. And we see the more efficient markets become, the more competitive the benchmark actually tends to be. Now, Ruan, this is not magic or luck. Remember that the price a company trades at in the market is a combination of all the algorithms and complexities used by analysts and managers, making it very hard to find arbitrage opportunities. Now, the cost saving and lower turnover benefits further makes it extremely hard to beat a well-diversified index because it reflects all the technological advances in the market in the prices that the stocks are trading at. Now, some might believe that the solution to this is to simply find those best managers. But even this is hard to do. So this slide shows us that what this slide is showing us is that the past 3 years top performers are colored in green and underperformers are colored in red. And what we do is at each given year, we then rank managers in a given year based on their current performance. Now think about this. If manager performance were consistent, then you'd see all the greens at the top and all the reds at the bottom, indicating if a green is at the top, you were a past top performer, and in that year, you are again repeating that feat. But what this graph is showing us is that consistency is extremely rare and finding winners very, very hard to do. And in fact, past performance is not a great guide for future performance. Now, despite this evidence of a lack of consistency and the strong performance of indices, we still see flows are predominantly going towards past winners. Now, what this slide shows us is that the flows in a given year that went to the past 3 years' top quartile performers, that's in light blue, versus the flows going to the past 3 years' bottom quartile performers. That's in dark blue. And what you see is that flows are predominantly going to the light blue and out of the dark blue. Now, this clearly shows us that investors were hoping each year that this time will be different and that performance will actually persist and that the winners will remain winners. Sadly, since 2015, this did in fact not happen, and investors would have been much better off chasing the losers as opposed to chasing the winners.
So, with indexation strategies clearly showing that consistency and low costs make for greater certainty in outcome, and systematic strategies in total still making up less than 15% of the general equity category, is there something innately human about this behavior that can help us make sense of it?
So it is important to state up front that we appreciate and acknowledge the vitally important price discovery role that active managers play. And we cannot only have indexation strategies in the market. But that being said, it is hard to understand this underappreciation locally of the long-term benefits that indexation offers investors. We'd probably need to turn to behavioral finance to understand exactly why. Now, humans are predisposed and actually quite good at finding patterns in noise and making order from disorder. Now, we apply this behavior to investing as well. Consider, for example, the well-known fact that individual stock returns typically represent random noise, especially over the short term. Now, despite this, we hope that certain experts in the market are able to make sense of all the noise consistently. And our hope is that these experts will find a way to make themselves known and hopefully do so through excellent performance. Yet there was a fascinating study done by Paul Zweig to show this point exactly. They put a green and a red button in front of a mouse. Now, the green button lit up completely randomly 80% of the time, and the red button 20% of the time. Now, if the mouse guessed the correct button, then it got rewarded with food. And of course, if it guessed wrong, it got a mild shock. Charming. Now, what they found from the experiment was that the mice caught onto this very quickly and virtually always pressed the green button, getting the reward 80% of the time. Now, the funny thing is, Ruan, when humans were given the exact same task, unfortunately without the mild shocks though, I think that would have been really interesting. But when they were given the same task, they soon looked to try and game this random process. People tried to find patterns in the noise and tried to predict when the red button will flash, even when it was completely random. So the result was that the mice earned 80% rewards, and the humans, trying to chase the randomness, on average only got 68% of the reward. Now, if you recall from our earlier graphs, the capped SWIX and CAPI indices outperformed active managers roughly 80% of the time over 3 years. So this means there is quite a strong parallel in our hope that managers, on average, display better results. While of course this doesn't hold true for every active manager, most investors would actually be better off pressing the green index button more often than we're seeing.
Yeah, Nico, I'm pretty sure that there's an of mice and men joke in there somewhere, but I won't venture there. So with all that we've discussed, I want us to also touch on the relevance of local-only equity indices to our local investors. So they've also got a choice of investing with active managers that can actually access, or many of them can access, 45% offshore assets. So would it be beneficial for clients to consider a portfolio where they actually take something like the SWIX and add the MSCI World to it?
Yeah, so creating a blend of local and global equity exposure using low-cost indices like I've shown you can definitely be done. And it can offer investors great diversification benefits and also a hedge to the rand. Now, similar to the local indices I showed you, the MSCI World Index has been incredibly hard to outperform for global active managers. So the graph that I show you now shows the rolling 3-year relative performance of between 1,500 and 3,000 global active managers within Morningstar's greater global equity category. And what it shows is that over the past 10 years, the median active manager, that is the black line that you see there, has never outperformed the index on a rolling 3-year basis. So while you do see certain managers managing to outperform in the short term, it's incredibly hard to do so over any meaningful period. Now, we can, for example, use this index that you see here, the MSCI World, that trades as a feeder ETF locally, to blend with our local CAPI or capped SWIX equity indices to create this composite blend that you're mentioning now, to put it on a more equal footing with local managers that are able to allocate some part of their portfolio offshore. Now let's see if this improves the returns, and let's do so by first looking at the rolling 3-year performance of the CAPI versus the median active manager returns since 2004. Now from this, note that the CAPI outperformed more than 90% of the time, similar to what you saw on the distribution chart, and delivered an excess return of about 1.9% annualized. So a significant gap created between the CAPI and the median active manager over time. Now, if we blended the CAPI with the MSCI World Index in rands, the performance would have been even more volatile, as one would expect, right, with the rand being quite volatile, but with slightly lower percentage outperformance of 75%. Despite this, you do see a higher cumulative return of 2.7% relative to active managers over time. Now, if we consider the capped SWIX instead, it too enjoyed success compared to the median active manager over time, albeit less in the past few years, specifically as rand weakness has dragged somewhat on its performance, considering what I've shown you earlier. Now, if we blended the capped SWIX with the MSCI World, it would have greatly benefited the last 3 years. In fact, the underperformance that we saw from the capped SWIX relative to active managers would all but disappeared if we did blend it with the MSCI World. But similar to the CAPI, it would have suffered a bit in the pre-quantitative easing cycle that you see there pre-2010. Now, the blended approach here shows a big reason for why active managers mostly outperformed the capped SWIX recently, right? And it's due in part to holding more offshore of these offshore counters, so your Richmonds, your Billetins, and your Nasperses that were heavily upweighted in the Aussie. So in conclusion to your question, it is not an easy answer, and is certainly very much a decision that each investor or advisor should make very carefully, as offshore equity allocations are never necessarily a slam dunk, and it definitely carries with it its own risks. But it can certainly be done, and in future this is the type of questions you would definitely need to ask yourself.
All right. So speaking of risk, are index returns not much more volatile, considering the fact that they follow a set of rules and they can't deviate from them? So should investors not take more comfort in choosing an active manager that can actually select stocks and try to manage their downside risk?
So this is a question we often face, and specifically it feels like almost like convincing someone new to indexation to step into a driverless car. The reality is that vanilla as well as non-vanilla indices are actually designed to be very well diversified, and that changing strategic weights might not necessarily improve stability at all. Now, if we consider the total yearly variation in price for large, mid and small cap stocks on this slide through time, then you find that these companies deviate from peak to trough roughly between 30 to 60% in any given year on average, right? So that box plot that you see there gives you the top and bottom quartile peak to trough deviations for your individual counters on the all-share index. Now compare this, if I add, to the index alternatives at the bottom there, the Aussie and the SWIX, that deviate between 10 and 20% peak to trough on average in a given year. Now this shows that diversified indices as well as actively managed portfolios significantly smooths your investment returns over time. And remember, this is vital, as arithmetic returns are not linear. I always say this, being down 50% the first year and up 50% the next year puts you at 75 cents to the rand, not the 100. So volatility can be a great source of anti-compounding through time. Now I don't show it here, but we've also done work that show even during sharp market downturns, active managers perform very similarly to index alternatives on average that are themselves already well diversified. So it's very hard to actually have that volatility buffer that active managers sometimes say that they can offer that indices can't. So the benefits of having someone at the wheel, so to speak, does not actually come through strongly in returns or in volatility reduction. And it's a compelling offering to suggest holding some part of your portfolio in indexation.
Thanks, Nico. So I want to end off with a discussion into your factor portfolios. So you recently made the comment that factors have struggled, but they're not dead. I want to understand exactly what you meant by that and where you see the future for factor investing.
So you're right in saying that the last year was particularly challenging for factor strategies across the board. Now this includes even more recently the value and dividend yield strategies that were, if you recall, the darlings of the market last year. Now, the pain was even more compounded to those factor strategies that managed their active risk to the capped SWIX, considering its underperformance to the Aussie due to its exposure to Naspers and Richmond. Now, the median manager in South Africa there on the left were able to outperform most systematic strategies over the past 12 months. Now, although historically this has been the exception and certainly not the norm. So we wrote a piece called Are Factors Dead?, where we discuss the underperformance and give you some perspective as to why these factor strategies actually struggled. So you can find a link to the paper at the bottom of your screen. Now, our main conclusion from this is that factor strategies are not dead, as the title suggests, and that such periods of underperformance actually do occasionally occur over time. Ultimately, though, fundamentals may matter less compared to individual stock features in the short term, but ultimately the principle of what pays risk premiums matter long term. And so for us, it is a lull and certainly not a death knell. Now, if we look at our own multi-factor strategy, SmartCore, we know it had a challenging 12 months in line with this general systematic or factor portfolio underperformance, but it still remains well ahead of its CapSwix benchmark since inception. As you can see there, 9.1% annualized versus 7.6% for the CapSwix. So still very much adding value and doing what it's saying on the tin.
Right, so you mentioned that factor strategies work in the long term, but how does it stack up against those index alternatives that we discussed earlier that consistently seem to manage to outperform active managers?
Yeah, so interestingly, factor strategies, which can be thought of, again, as a refinement to vanilla index rules, have actually performed very strongly when compared to the vanilla alternatives that I showed you earlier. And just, I don't need to re-emphasize how well those vanilla indices have actually done to active managers. Now, even the MSCI World Index that has done so well over time and has been such a consistent performer has since 1975 actually trailed most of its factor index alternative strategies. Most strikingly is that if you give it time, these strategies show a very high probability of outperformance. And specifically that last column there, the multi-factor column, you can see if you give it 3 to 5 years, the very high likelihood of it adding value. Remember, that is a culmination of a lot of the insights that we gain from the financial literature and baked into a strategy. Now, locally, we see the same too. Our factor indices have performed very well compared to its stated benchmark, the CapSwix, both in terms of its backtests as well as since it started trading live. Now, the numbers on this slide is actually quite similar to that of the MSCI, showing specifically that a multi-factor blend on the right there tends to outperform with great consistency over the medium to long term. And that for us is the key. We consider factor strategies as long-term sources of alpha and not short-term arbitrage opportunities.
Right, Nico, so the Satrix SmartCore Index is available both as a unit trust on its own, but it also forms the equity core of the multi-asset portfolios. So considering that factors have struggled, what has been the impact of SmartCore on the Satrix Balanced Fund?
Yes, so SmartCore is the local equity building block within our balanced fund range, and we believe the medium to long-term benefits of harvesting these factor premiums offer a key differentiator for us in the rules-based balanced fund category. Now, while the past 12 months certainly were challenging for us from a factor perspective, as you can see from our relative performance, we still see a strong performance over all the other considered timeframes that you can see on this slide, where our strategy delivered quite consistent top quartile performance and certainly managed to beat all of its competitors from a peer perspective on a 3, 5, and 7-year basis. Now, this is also very well summarized in this graph that I'm showing you now, where our balanced funds value proposition comes through very clearly, in that over any given rolling 12-month period that you see on the left, you are outperforming the category median nearly 60% of the time. So you don't want to be in that red bar. You are above the red bar 60% of the time on a rolling 12-year basis since inception. But what's fascinating is over the 3 to 5 year time frame, this percentage increases to well over 95%. Now, this follows as our focus on getting our long-term strategic asset allocation right while limiting management and trading costs through the use of efficient index tracker funds really does pay off over 3 to 5 years, where making up costs through tactical adjustments become extremely hard to do. And in fact, the literature has shown that making tactical decisions and very consistently to add value is incredibly hard to do. Now, lastly, we've also seen a greater adoption of rules-based strategies, as you can see on this slide, which shows the flows into the balanced fund, the high equity balanced fund range. And with close to half of assets in the last year flowing to within the high equity balance fund flowing to rules-based alternatives, as you can see there on the right. Now, we believe this trend is set to continue as investors more and more are seeing the value in focusing on the long term, sticking to a set of rules, limiting your costs, and using low-cost index building blocks to construct a balanced fund.
Nico, thank you so much for your time. I think we've run out at this stage. Ladies and gentlemen, thank you so much for joining us. I want to invite you to look at the platform, and there will actually be the link to the slides that Nico covered, and we'll also have some links to the articles that he mentioned. Nico, thank you very much, and I'm going to hand over back to Gili and Nico, who will be handling some of the Q&A at the end.
And good morning to our audience, and good morning, Nico. I want to start off with our Q&A section by just reminding you we've had some questions from our audience on how to access articles and related content. At the bottom of your screen on the right-hand side, you should be able to see a paperclip icon. You can click on that paperclip icon and it will open the view for you to access related content and articles. Or if you've by accident closed it, it would appear on the bottom left of your screens. If you are struggling to access these articles, please make contact with us and we will provide you with whatever you need. So, morning, Nico, over to you. I'm going to dive right into it. We don't have a lot of time. So, first of all, as you mentioned in the presentation, that the CapSwix is the most widely used benchmark for active managers. Could you please elaborate on that comment?
Sure. Look, it's a great question. It's extremely relevant. I said it a few times, but I didn't elaborate too much in the presentation. Although it is hard to accurately gauge what the most widely adopted benchmark is for active managers across the retail and especially the institutional space, our research has certainly shown that active managers more closely manage active risk to the CapSwix from both a relative as well as actually from a style alignment perspective. It's also quite evident from how closely the median active manager Rand managed in South Africa tracks the CapSwix. If you recall that one slide where I showed median active managers, actually the returns actually quite closely mimic the CapSwix minus costs. And our research also shows, in fact, that active managers are quite consistently distributed around the CapSwix from a style perspective. So that's not from a momentum or value or quality tilt perspective. So what we generally see is that active managers replicate the CapSwix from a style perspective, and then from that, they take their active bets. So while it doesn't necessarily apply to all managers, of course, what we see is that it applies to most, that the CapSwix is the most relevant benchmark. And what's also nice about that is the alignment that I spoke of, the index harmonization is happening next year, March, and it's going to align itself to the Swix methodology. So we hope that this means that there will be less disruption, if you like, in terms of portfolio readjustments to align to this new adopted benchmark from the JSE.
Yeah, thank you, Nico. And then you mentioned in the presentation as well that our local Rand hedge stocks performed very well last year. And I think the question on top of many investors' minds would be typically, are these stocks sufficient to guard investors against Rand weakness? Or should investors actually consider moving larger components of their portfolios offshore?
A brilliant question. I think maybe if we can take a step back, when we talk about Rand hedge stocks, we mean locally listed companies that perform comparatively well when the Rand weakens. Now, this can be due to a range of factors, but generally it is due to these companies such as, for example, Richemont or AB InBev or Prosus, for example, deriving much of their earnings from offshore. This means that these revenues are accrued in dollars or pounds or euros and then brought back in Rand. So investors have the benefit of these earnings being in a foreign denominated currency. And so you have that additional boost, if you like, in revenues when the Rand weakens. But I think it's very important for us to always keep in mind that locally listed, especially locally listed Rand hedge companies, are still exposed to the same local constraints, local policies, the load shedding blues that are faced by other local companies. And so it's important to keep in mind, to get a proper Rand hedge in their portfolios, investors might look to build in direct forms of offshore exposure. Now, we know that investors generally have a local bias, or home bias, if you like, and so oftentimes try to find this Rand hedge through these Rand hedge stocks. But there's actually ways that you can easily and quite cost effectively get this offshore exposure. For example, through feeder ETF options that will allow these local investors an easy way to get this exposure directly and at a very low cost. So just keep that in mind when we talk about Rand hedge stocks. It's not a perfect hedge, and there's actually more direct ways of getting that offshore exposure that might be extremely beneficial to investors as well.
Yeah, let's take our attention to the Smart Core offering, the equity component or equity fund that you offer locally. The fund has had a very exceptional strong month, the last past month, but let's be honest, the fund is still behind its 12-month benchmark. Can you maybe share with our audience or explain the components of this underperformance firstly? And then maybe secondly, just share your outlook of this fund going forward, let's say medium to long term, please, Nico.
Yeah, thanks, Kelly. So at the end of the presentation, we very briefly covered Smart Core. We've done so in more detail in past presentations. And so investors that have seen this in the past will know that the last 12 months have been challenging for Smart Core, but not only for Smart Core. It's very much in line with most systematic factor strategies over the past year that had a challenging year. And so we wrote an article, Are Factor Investing Dead? That you can access in the link. And if you can't get in the link, just be in contact. And in this, we delve in greater detail to what I will be saying now. This underperformance the past year can be attributed largely to a few key features related to this past year. So one being the very strong performance of a handful of stocks, like I showed you, Richemont, Anglos, and a few others turns, and which the benchmark indices were extremely overweight. If you recall, your Aussie had an average weight of 15% to Richemont, and Richemont had a close to 100% return over the last year. Now, if you think about that, no systematic strategy would have been overweight Richemont. It's almost nearly impossible if you think that it's by most estimations, it's quite an expensive company. So systematic strategies or factor strategies would have typically been quite strongly underweight Richemont. And that was the case for Smart Core as well. Another key reason for the underperformance of factor strategies has been the market's strong pivot last year. Now, markets tend to be able to pivot quite strongly. For example, Russia invades Ukraine, and so you see a strong market pivot. So a strong reaction to movements. Now, these short-term events, as we've seen in the past of heightened uncertainty, they tend to make fundamental strategies less relevant in the short term. But we've always maintained that systematic factor strategies should be considered from a long-term perspective, and certainly not from a short-term perspective. So in other words, we don't see it as arbitrage opportunities to try and take advantage of in the short term, but we see these premiums as paying off over a 3 to 5 year period, for example. So, even though Smart Core has had a great month in the last month and it's starting to recover, we look at it more from a 3-year plus perspective. And on that basis, Smart Core has still quite comfortably outperformed its benchmark as well as active manager peers. So we certainly believe that the true value for factor strategies crystallize in the medium to longer term.
Well, Nico, thank you very much. That's how we've run out of time. Obviously, we can keep on talking about some very interesting components inside indexation, but thanks for joining us today and sharing your views. And to our audience, thank you very much for joining us. We do appreciate you spending time or selecting to spend time with us today. And until we meet each other again, I hope you've got a great day and a great rest of the week. Goodbye.